Hello everyone, John AG here, and I need you to stay with me from the first second because something changed in the system before most people even noticed. Not a meme, not a rumor, not a vibes thing. The financial plumbing flashed a warning light, Treasury liquidity tightened, and the kind of emergency pivot that usually takes weeks of public debate basically went live in silence. And that's the part that should scare you a little, in a way. Because when the big decisions happen quietly, the public usually gets the explanation later, after the price has already moved. So let me ask you a simple question right now. Are you watching the headlines or are you watching the pipes? Now, quick and professional, and then we move. I'm running a campaign to push back against copycat channels that recycle other people's work without adding value. If you want to support me, subscribe and drop a comment, even if it's just our John AG, so the algorithm knows this content matters. And if you want my daily updates, short posts, and the stuff I don't always put on YouTube, instant voice notes, rapid alerts, and my raw read when things move fast, there's a WhatsApp channel link in the description. Join it because that's where the premium real-time layer lives. All right, here's what we're doing today. I'm going to take a messy, chaotic set of events and turn it into a clear map. We're going to look at three layers that are colliding right now: the political wildcard layer, the liquidity layer, and the technology layer. Then we'll talk about what that collision does to volatility, why volatility is both a trap and an opportunity, and how people get emotionally baited into the worst decisions at the worst time. And near the end, I'm going to give you a simple framework you can use the next time everyone is screaming on social media so you don't become exit liquidity for someone smarter than you. Now, first layer, politics. This is not just noise. It's a risk engine. Tariffs are a massive wild card because tariffs don't just change prices, they change confidence. A business doesn't invest because a spreadsheet says maybe. A business invests when it can see stable rules. Tariffs threaten stability. They reorder supply chains. They create winners and losers overnight, and the market hates that because the market prices future cash flows and tariffs make future cash flows foggy. Then you add the second wild card, geopolitical escalation. Sometimes it's a threat. Sometimes it's a standoff. Sometimes it's a sudden event. But even the possibility of military involvement at the wrong time can ripple straight into energy markets, shipping costs, insurance premiums, and currency flows. Energy is not just a commodity. Energy is a heartbeat. If that heartbeat gets irregular, everything else feels it. Now, I'm not saying politics is the only driver of the recent moves we've seen in defensive assets and precious metals, but it is an accelerant. It makes people reach for safety. It makes traders demand a risk premium, and it makes volatility easier to trigger. But the deeper driver, the thing under the headlines, is the second layer, liquidity. This is the part that sounds boring until it suddenly becomes the only thing that matters. We shifted away from the tightening phase and toward a more easing-oriented stance. Some people saw the headlines and treated it like a surprise. But if you were watching the stress indicators, it wasn't a surprise. It was a window. Late 2025, early 2026, somewhere in that zone, you could see the pressure building. Because the system can tolerate a lot, but it cannot tolerate broken plumbing. And when I say plumbing, I mean the markets that keep money moving. The Treasury market, the repo market, and the overnight funding lanes between institutions. If those markets stay liquid, the system stays alive. If those markets seize up, nothing else matters for a while. That's why, when those markets look fragile, the response is fast. Not because officials love making markets happy. Because the alternative is a chain reaction. Margin calls, collateral shortages, forced selling, and a feedback loop that can crash confidence. And here's the key detail most people miss. Central banks have standing facilities now. They have tools that let them step in earlier than in prior decades. They can add liquidity before the pain becomes obvious to the public. So the pivot can look like it happened overnight, even though the pressure was building for months. Now, does that mean every asset goes straight up? No, and if someone tells you that, they're selling you a fantasy. Rising base money and rising broad money create a background bias, but valuation still matters. An overvalued asset can go sideways or down for years while money supply grows. You can have money supply growing 6% annually and still watch a market compress from a ridiculous valuation to a merely expensive valuation. That compression is slow, it feels unfair. It ruins impatient people. So yes, liquidity matters, but it doesn't erase math. Now, third layer. Technology. AI is not just a trend, it's a structural shift. It changes consumer behavior. It changes business spending. It automates tasks that used to require expensive labor. It pressures certain service margins. It creates big winners in infrastructure, chips, data, and certain platforms. And it creates quiet losers in businesses that depended on old workflow bottlenecks. So while liquidity pushes broadly, technology redistributes. That's why some stocks look unstoppable, while other sectors look like they're stuck in mud. And when you combine all three layers, politics, liquidity, tech, you get the environment we're in right now. Chaotic, fast, and full of opportunities and landmines. Now let me slow this down and show you the core mechanism behind the emergency pivot. When I say the system can run hot, I'm not only talking about inflation data, I'm talking about the moment the Treasury market becomes illiquid. Illiquid means spreads widen, auctions get shaky, dealers get cautious, and the cost of financing inventory jumps. Then I'm talking about the repo market, the overnight lending market where institutions borrow cash against collateral. Repo is not glamorous, but repo is oxygen. If repo gets tight, leverage gets forced to unwind. And when leverage unwinds, it sells what it can, not what it should. That's how you get weird moves where good assets drop with bad assets and everything feels broken. So when those pipes strain, the central bank steps in. Sometimes they do it openly. Sometimes they do it through facilities that look technical, boring, and harmless. But the goal is the same. Keep the core lanes flowing, keep reserves adequate, keep the system from choking. And here's where it gets spicy. The New York Fed and other official bodies like to talk in ratios like, we'll keep the balance sheet stable relative to GDP. That sounds responsible, right? But the problem is that fiscal deficits inflate nominal GDP. If the government runs large, persistent deficits, nominal GDP grows faster. So the ratio can look stable while the absolute balance sheet grows. It's like saying, my boat isn't sinking because the waterline is rising too. Technically true, comforting, but not the full story. Now, let's talk about fiscal dominance because this is the hidden engine. Persistent deficits mean a lot of new issuance. That issuance must be absorbed. To absorb it smoothly, the system needs liquidity. That pushes on monetary policy, even if nobody admits it. You can think of it like a silent hand on the steering wheel. The central bank may want one thing, but the funding markets demand another thing. And funding markets tend to win because when funding markets break, everything breaks. This is why the debt to GDP debate often misleads people. Debt to GDP spiked around 2020 and 2021, then nominal GDP rebounded. So the ratio can look better, but that doesn't mean the cost disappeared. It means the measurement got inflated. Countries with rapid inflation show the same illusion. A deficit can look smaller relative to current GDP because current GDP exploded in nominal terms. But the social cost is real. And that social cost shows up in how people feel. Right now, consumer sentiment is extremely weak compared to where equity markets are. That gap is one of the largest divides in decades. And that tells you the system is creating a split experience. Some people feel wealthy because assets are high. Some people feel squeezed because life got expensive. Some call it a K-shaped economy. Some call it a two-speed economy. I call it a pressure cooker. Because when millions of people feel like they are working harder just to stand still, you get political heat. And political heat changes policy. Policy changes markets. And markets change your life. Now, let's get specific. A huge chunk of deficit spending goes to interest expense, defense, and large entitlement programs. Those are massive buckets. If you are connected to those flows, you can do all right. If you are not connected, and you are also facing high interest rates, you feel punished. Think about a young family trying to buy a house. High mortgage rates, high home prices, big down payments. The math doesn't work, so people delay ownership, they delay children, they delay stability, and then they get angry. That anger is the fuel for populism. At first it is reasonable. It asks fair questions, then it gets louder, then it gets extreme if it's ignored. And it can come from the right or the left because the root issue is frustration. Now, here's a hard truth about inflation that people forget. Big inflation waves usually need energy inflation. Energy touches everything. Shipping, production, heating, food, services. Right now, we have some disinflationary forces in technology. AI can reduce costs in certain tasks, but we also have inflation in areas that are labor-intensive, capital-intensive, and hard to reproduce. Housing-related costs, healthcare, insurance, and many essentials. So where does the next inflation scare come from? In my view, it becomes more likely if energy tightens again. Under current prices, shale producers may not invest aggressively. Decline rates are real. If investment stays muted long enough, supply tightens, then you get shortages, then you get spikes. And when energy spikes, the entire inflation picture can change quickly. Now, add another wild card. What if the AI productivity boost arrives slower than the market expects? If the gains are real but delayed, they may not offset inflationary pressures coming from fiscal dominance and social friction. And yes, social friction is inflationary. Here's why. In a highly organized society with high trust, resources go into innovation and efficiency. Organization is disinflationary, but in a society with more crime, more protests, more polarization, more conflict, more bureaucracy, resources go into managing crises, security, compliance, and repair. You spend resources putting out fires, literally and metaphorically. That is like war. War destroys resources. That destruction is inflationary, so you get what I call a mayhem premium. It creeps in slowly, then one day people notice that everything feels expensive and they don't know why. Now zoom out again to demographics, because this is the slow motion earthquake. Many modern systems were built on an assumption. The next generation is bigger than the last. That assumption supported entitlement systems. That assumption supported tax bases. That assumption supported long-term promises. But across much of the world, that assumption is breaking. Populations are aging. Workforces are tightening. Entitlement systems become top-heavy. Intergenerational conflict rises. And then politics fights over the solution. Some places respond by inviting more immigration to patch labor gaps. Then you get backlash. Other places respond by tightening borders. Then you get shortages. Either way, it becomes political, emotional, and unstable. And this is not a quick fix problem. It doesn't cleanly resolve in 3 years. It doesn't politely resolve in 5 years. It tends to swing like a pendulum, and the swings can become more extreme. Now, I want to insert something here that is small but important for your mindset. If you want silver-related success stories, real stories from everyday people who found a strategy and made it work, there's another channel linked in the description. Go check it out, subscribe over there, and watch a few stories, because success leaves clues, and your mindset matters more than you think. All right, back to the main story, because we're approaching the cliffhanger. When politics is noisy, liquidity turns supportive, and technology reshapes winners and losers, the next market-moving event often comes from the place people are ignoring. Everyone stares at the CPI print. Everyone stares at election drama. Meanwhile, the pipes are what decide whether a week becomes a month and whether a wobble becomes a crisis. So here's the cliffhanger. The public will be told a story about why things changed, but the real reason will be the plumbing. And if you learn to watch plumbing, you get earlier signals than people who only watch headlines. Now, let me unpack the plumbing a little more, because liquidity is one of those words people nod at, but very few people actually visualize. Think of the Treasury market as the main highway for global finance. Governments issue the most widely used collateral on Earth. Banks, funds, insurers, and foreign institutions hold it, pledge it, and trade it. When that market is smooth, it's invisible. When that market gets rough, everything starts to rattle. What does rough look like? It can look like dealers refusing to hold inventory unless they get paid more. It can look like bid-ask spreads widening even in normally calm conditions. It can look like auctions that clear, but only with higher yields than expected. It can look like a sudden shortage of the specific collateral people need right now, not in theory, not next month, but right now. Then the repo market comes into the picture. Repo is where institutions get short-term cash by pledging collateral. It is the overnight heartbeat that keeps leverage stable. When repo is loose, leverage can breathe. When repo is tight, leverage panics. And here's the part that creates cliffhangers in markets. Repo can go from normal to stressed faster than most people can react, because it doesn't require a dramatic headline. It only requires enough participants to step back at the same time. If a few major lenders say, I want more haircuts, or I want better collateral, or I want less exposure, then funding costs jump. When funding costs jump, positions that looked safe at 2% financing suddenly look fragile at 6% financing. And that is where forced selling begins. Forced selling is brutal because it is not emotional. It is mechanical. It sells the liquid thing first. It sells the profitable thing if it needs to raise cash. It sells the good asset if that is what can be sold quickly. That's why you can see bizarre moments when gold, equities, and even high-quality bonds wobble at the same time. It's not because the fundamentals changed in 1 hour. It's because plumbing demanded cash. Now, when officials see that kind of stress building, they do not say, let's wait and see. They use tools. Sometimes it's an outright shift in policy stance. Sometimes it's balance sheet growth through specific instruments. Sometimes it's a facility that looks technical, like a repo backstop. Sometimes it's a quiet change in the rhythm of operations. But the goal is consistent. Stabilize the pipes. And notice how often the support is concentrated in the short end of the curve. Bills, short notes, the kind of collateral the system uses daily. That's not random. That's where the friction shows up first. Now, I want you to understand something uncomfortable. Even if the central bank says, we're not doing this to stimulate, the effects can still ripple into asset prices. Because liquidity does not politely stay inside one lane. If reserves rise, risk appetite can rise. If financing becomes easier, leverage can rebuild. If the sense of the backstop is there returns, investors can reach farther out on the risk spectrum. So you can get a situation where officials claim they're just doing maintenance, but markets feel like a party is starting again. And that's how you get the emotional split. The public feels squeezed while asset holders feel relief. Now, let's tie this to the fiscal side, because this is where many people get confused. Deficits are not just numbers on a chart. Deficits are flows. When the government spends more than it takes in, money moves into the private sector. Some of that money lands in households through programs. Some lands in contractors. Some lands in interest payments. Some lands in state budgets. And a lot of it circulates into asset markets because large pools of capital look for a home. Now, the constraint conversation often focuses on debt levels, but in practice, governments can keep the ratio stable by inflating nominal GDP. They can grow the denominator, they can run money in growth in a way that makes the math look manageable. But again, the cost is social. People notice when the value of money feels weaker. And when people notice, politics shifts. Politics then shifts policy. Policy then shifts markets. So it's a loop. Now, let's go deeper into the idea that a rising money supply is a tailwind, but not a guarantee. If you buy an asset at a ridiculous price, you can still lose money in real terms for years. You can sit through a lost decade, even while money supply grows. And the reason is simple. Valuation is gravity. Gravity doesn't care how optimistic you are. If multiples are high, the future returns are pulled forward. Then the market can spend years digesting that. It can be boring, it can be painful, and it can make people give up right before the next big move. That's why in this era, the crowd is vulnerable, because the crowd has been trained to believe everything dips and bounces quickly. But regimes shift, and when regimes shift, patience becomes an advantage again. Now, let me bring in the technology layer in a more practical way, because AI is not just about stock tickers. AI is about labor substitution. AI is about service delivery. AI is about whether a company needs a team of 50 to do a job that a team of 10 can do with the right tools. That creates deflation in some services. But it does not create deflation in everything. It does not build houses. It does not mine copper. It does not pump oil by itself. It does not magically repair supply chains. So you can have a world where some digital services get cheaper while physical essentials remain expensive. And that split can confuse people. They see cheaper software subscriptions. Then they see higher insurance. They see a free AI tool. Then they see higher rent. And they wonder, why does it feel like I'm losing ground? That's the two-speed economy again. Now, here's a cliffhanger inside the AI story. If the market overprices the speed of AI benefits, you can get a bubble. And bubbles are not just about bad companies. Bubbles can happen in good companies too, if the price gets too far ahead of reality. So it is possible to be right about the trend and wrong about the timing. It is possible to be right about AI and still get wrecked if you buy at the wrong price. That's why I keep repeating, the narrative is not enough. The price matters. Now let's connect this to currency volatility. When a country runs persistent deficits and supports liquidity, it can still see bursts of currency strength if other regions are weaker. But longer term, persistent debasement pressures accumulate. And that creates a strange environment where people argue daily about the dollar going up or down, while the deeper trend is about purchasing power. Purchasing power is the silent metric. Purchasing power is why people feel poorer even when their bank account number rises, because the unit is shrinking. Now let's bring energy back into the spotlight, because energy is the bridge between geopolitics and inflation. Energy is where a political event can become an economic event in hours. If shipping routes get threatened, energy moves. If sanctions shift, energy moves. If production declines quietly because investment slowed, energy moves. And when energy moves, it touches everything else. So here are 3 scenarios I want you to consider, and I want you to think about them like an investor, not like a headline addict. Scenario 1, energy stays relatively calm. In that scenario, inflation pressure can cool gradually. Technology deflation helps a little. The central bank can manage the narrative. Markets may grind, rotate, and become more valuation sensitive. You might see parts of equities stall, while other parts do fine. You might see more of a stock picker's market than a buy the index and forget it market. Scenario 2, energy tightens slowly, then spikes. In that scenario, inflation expectations jump. Policy gets trapped. Officials want to support liquidity, but inflation makes them hesitate. That hesitation creates sharper volatility. Bond yields can whip around, equities can wobble, commodities can surge, and the public reaction can get intense because energy inflation is visible. People don't need a report to notice gas prices. They see it immediately. Scenario 3. Energy stays calm, but funding stress returns anyway. This is the one people ignore, and it's the one that creates the biggest surprises. Because you can have a calm inflation picture and still have a funding problem if collateral distribution breaks, if leverage piles in the wrong place, or if a shock hits confidence. In that scenario, you can get a sudden pivot even without an inflation emergency. You can get technical operations that turn into balance sheet growth. You can get a market that rallies because liquidity returns even while the real economy feels heavy. Now, do you see why this is such a weird era? You can have strong asset prices and weak sentiment at the same time. You can have technology creating efficiencies while housing stays unaffordable. You can have stable debt to GDP while people feel the social contract weakening. That is the regime. Now, I want to put a spotlight on the human side again because it matters for markets. When people feel squeezed, they become more politically active. They demand solutions. Sometimes those solutions are smart. Sometimes they are reactive. Sometimes they are short-term. Sometimes they are extreme. And policies that are reactive can create second-order effects that markets don't price immediately. A tariff is not just a tariff. It is retaliation risk. It is supply chain reshuffling. It is margin pressure. It is inflation pressure. It is a confidence shock. A new spending package is not just spending. It is future issuance. It is higher interest expense. It is more money into the system. It is more pressure on the central bank to keep funding smooth. So again, it's a loop. Now, I want to address the investor psychology trap that kills people in regimes like this. When volatility rises, the crowd becomes addicted to prediction. They want to guess the next headline. They want to call the top. They want to call the bottom. They want certainty, but certainty is expensive. The market charges you for certainty. If you wait for certainty, you usually buy high and sell low. So instead, you build a process. You decide what you own and why you own it. You decide what would make you sell. You decide what would make you add. You decide how you handle drawdowns. You decide how much cash buffer you need so you don't get forced to sell. And then you execute without drama. Now, let's make it even more practical. If you are a long-term investor, your biggest enemy is not volatility. Your biggest enemy is being forced to act at the wrong time. That force can come from leverage. That force can come from lack of liquidity. That force can come from emotional panic. So the goal is to remove force. That's why I talk about reserves and plumbing. Because if the system tightens, you want to be the person with options, not the person begging for options. Now, we're going to return to the demographic layer for a moment because this is where long-term pressure lives. Aging populations mean rising healthcare and pension burdens. That means governments face higher spending even if they want to cut. If they try to cut, they face backlash. If they don't cut, deficits persist. Either way, the path of least resistance often becomes gradual debasement, and gradual debasement is sneaky. It doesn't feel dramatic week to week. It feels dramatic over a decade. That's why people wake up one day and say, how did life get so expensive? Now, remember what I said earlier. Social unrest is inflationary because unrest forces resources into security, enforcement, compliance, and repair. Unrest is expensive. Polarization is expensive. Bureaucracy is expensive. And when you combine that with energy risk and funding risk, you get a world where surprise inflation bursts remain possible. Now, I want to give you a quick story-like example because stories stick. Imagine a week where nothing major happens in headlines. No war announcement, no big crash, no famous CEO scandal. But inside funding markets, a few big players pull back. Haircuts rise slightly. Funding costs rise slightly. Then a leveraged trade that was fine last month becomes shaky this month. That trade unwinds. It sells some liquid assets. Prices dip. Other players see the dip and reduce risk. That reduction tightens liquidity further. Now spreads widen more. Now the stress is visible. And then, out of nowhere, you get a policy response. The public asks, why is the central bank doing this? The answer given is a nice story, but the real reason is the chain reaction you didn't see. That's how it works. Now, if you're watching plumbing, you see the early signals. And early signals are the difference between reacting and planning. Now let's connect all of this back to your portfolio. I'm not telling you one asset is guaranteed. I'm not telling you a magic ticker. I'm telling you the environment. In an environment with persistent deficits, periodic liquidity support, and political wildcards, you should respect hard assets and scarcity. You should respect cash flow. You should respect valuation. You should respect diversification. And you should respect liquidity, your liquidity, not just the markets, because your liquidity determines whether you can hold through volatility. Now, I want you to think like this. If volatility hits tomorrow, what would force you to sell? Is it margin? Is it debt? Is it fear? Is it lack of cash? Answer that honestly, because that answer tells you what to fix. Now, we're close to the end, but I want to keep retention strong by reminding you of the bigger cliffhanger. The next big move in markets is rarely triggered by the thing everyone is currently screaming about. It's triggered by the thing nobody bothered to monitor. So keep your eyes on funding. Keep your eyes on energy. Keep your eyes on political incentives. Keep your eyes on valuation. And keep your mind calm. Because in the next spike, the people who stay calm are the people who buy the future at a discount. And the people who panic are the people who donate their wealth to the calm ones. Now, I want to talk about opportunity, because chaos is not only danger. Volatility gives you entry points. Volatility gives you exits. Volatility shakes out weak hands. Volatility creates discounts. But volatility also creates traps, because it tempts you to overtrade, to chase, to panic, and to make emotional decisions. So the question becomes, how do you separate opportunity from trap? You start by asking, what are people missing? When everyone is distracted by one story, the best opportunities often sit in the ignored corner. Sometimes it's a sector that got hated for the wrong reason. Sometimes it's an asset that is cheap relative to fundamentals. Sometimes it's a currency trade the crowd isn't watching. Sometimes it's a rotation inside the equity market that no one notices because they're glued to one index. And here's the key. You don't need to predict every headline. You need to be positioned for regimes. A regime is an environment. Rising liquidity, rising deficits, social pressure, tech disruption, geopolitical risk. If you position for that environment, you don't have to nail the day. Now, a quick reality check. Even in a debasement environment, stocks can stall for years if they are too expensive. Valuation can compress, multiples can shrink. Earnings can be fine and still not save you if you overpaid. That's why diversification matters. That's why you do not bet your future on one narrative. Now, let's zoom into currency markets for a moment, because currencies are where the pressure often shows first. When geopolitical tension rises, money seeks safety. When central banks signal different paths, money flows accordingly. When yields shift, capital moves. And if you have persistent deficits and persistent monetary support, currency strength can become unstable over longer time frames, even if it looks fine in short snapshots. So you can get bursts of strength, bursts of weakness, and a lot of whiplash. That whiplash is opportunity for disciplined traders. But it's also a place where undisciplined people get wrecked. Now, I want you to picture the system as a set of stacked plates. Top plate, headlines. Middle plate, markets. Bottom plate, funding. If funding plate wobbles, everything above it shakes. That's why I keep coming back to repo and Treasury liquidity. Because if those crack, the central bank does not ask permission. They act. Now, let's return to the question of debt constraints. A lot of people think the constraint is purely too much debt. But history suggests the system can inflate nominal GDP to keep the ratio from exploding. The constraint is the social consequence. The constraint is that people notice. People notice their groceries. People notice rent. People notice insurance. People notice that the economy feels different depending on whether you own assets or you rent life. That's where the two economies narrative comes from. And that's where the political consequences come from. Now, I want to make this practical. If you are watching this, you are already ahead of most people. Because most people don't even think about plumbing. They think about price. They think about tips. They think about someone promising them a sure thing. But the people who build wealth, the people who keep it, are the people who understand regimes and risk. So here's what I want you to do. First, identify what part of your exposure is pure narrative. Second, identify what part of your exposure is diversified and durable. Third, identify what part of your exposure is dependent on cheap funding. Because when funding tightens, the cheap funding trades suffer. When funding loosens, they recover. Now, are we in a world where funding stays loose forever? No. We're in a world where funding loosens when plumbing is stressed, tightens when they try to cool inflation, and then loosens again when something cracks. That creates a rhythm. And if you learn the rhythm, you stop getting surprised. Now, let me address something you might be thinking. You might be saying, okay, John, you've painted a chaotic picture. What do I actually do? Here's the answer. You focus on what you can control. You cannot control central banks. You cannot control geopolitics. You cannot control how quickly AI changes industries, but you can control your process. You can control your savings rate. You can control your risk exposure. You can control whether you chase or whether you plan. You can control whether you get emotional or whether you stay structured. And in an era like this, structure is an edge. Now, I also want to keep the community strong because investing can be lonely and fear spreads fast. If you have a success story, even a small one, share it in the comments. A win is a win. And when you share it, it lifts someone else. It makes the community more resilient. Now, as you're watching this, a members-only video should already be live. That members video bundles the key updates and the deeper timeline in one place. If you want the in-depth breakdown, join the membership, watch that episode, and you'll get the premium analysis that goes beyond the normal public format. And honestly, it also helps me see who is truly following the work, because it separates casual viewers from committed learners. Now, let me hit you with 2 engagement questions. And I want real answers. Question 1, what do you think is the most dangerous blind spot for investors right now? Political risk, liquidity risk, or tech disruption? Question 2, if energy prices spike again, do you think the public reaction will be calm? Or will it trigger a wave of panic policy? Drop your answers in the comments. And yes, if you want to support the campaign against recycled content, type our John AG as well, because that simple comment helps more than you realize. Now, here's the last cliffhanger, and it's the one I want you to remember. The next crisis, if it comes, will not announce itself politely. It will start as a small funding stress, a few spreads widening, a few auctions feeling sloppy, a few institutions getting cautious. Then suddenly, the narrative will change, and the media will pretend it was obvious. But you'll know better. You'll know it started in plumbing. And that knowledge gives you time to adjust, time to hedge, time to avoid panic selling, time to buy when others are forced to sell. So here's the takeaway. In a world of persistent deficits, periodic monetary support, political wildcards, and tech disruption, the crowd will get whiplash. They will chase, they will panic, they will blame, and they will miss opportunity. Your job is not to predict every headline. Your job is to build a process that survives regimes. So if this helped you, do 3 quick things. Subscribe to support the mission against copycats. Join the WhatsApp channel in the description for daily updates, voice notes, and rapid alerts. And check the members-only video for the full in-depth update package that's already published. Then leave a comment, rjohnag, and tell me which risk you're watching the closest. Take care of yourselves, take care of your families, keep your mind calm, and I'll see you in the next video.